Hello, welcome. My name is James, and in today's lesson, we are going to talk about leverage, PIP, and spread. So, what is leverage? Now, leverage is a trade size multiplier, and leverage is very important for you to learn about leverage, PIP, and spread in forex trading because it will become very crucial, especially when you want to start trading. So when you look at leverage is a trade size multiplier, which means it enables you to borrow a certain amount of money that allows you to trade in much bigger deals. So a leverage represents a margin trading ratio. Leverage will allow you to trade using more money than you have in your account. So that is one of the advantage of leverage. So anytime you want to enter into the forex market, you need to consider the broker's leverage. Okay, so if you're signing up with a broker, you need to consider how much leverage they're offering you, because it will be very crucial depending on the balance, or rather the investment that you want to make. So leverage will just help you uh, it will help you trade using more money than you have in your account. So we're going to be talking about that. Now, currency rates move very slowly, and this makes trades unfashionable as they only return small profits and losses for every pip rate changes. So therefore, leverage helps one to trade in larger deals, hence amplifying their potential profits or losses. So you make huge profits if you trade well, and you can also make large losses if you trade badly. So that's why you really need to learn about forex trading before you can go into this. Now let us look at the second thing that you need to know about, which is PIP. PIP stands for price interest point, and it represents the smallest change in a currency pair. So I think probably in future I'll be able to explain more about pips, how they work and how they came to be in forex. So I'll explain to you about that so that you can understand why when you're trading, your trading positions are measured in pips. Now, typically, pips. When you look at pips, it's typically the fourth decimal point. Although many brokers quote using the fifth decimal point. However, the fifth decimal point doesn't really affect the price as it changes pretty quick. Now, currency pairs that include the US dollar, a pip is 1/10,000 of a dollar, whereas when the currency pair includes the yen, a pip is 1/100th of a yen, because the yen is closer in value to 1/100th of other major currencies. So if you look at the Euro USD pair, for example, if you want to know what's a pip or a point, you look at the number here. So you can see this number figure with 4 decimal places, 1.2302. So the number 2, which is marked in green, is what represents our pip point. So this is an equivalent of 2 pips. So the number 2 that is in green represents 2 pips. Now let us look at a spread. In forex trading, brokers quote the bid and ask price for the currency pair. So the bid is the price that a trader can sell the base currency, while the ask price is the price they can buy the base currency. So spread refers to the difference between two prices. Now we should know that brokers offer you spreads, and spreads is how they make money. They make money through spreads. So they make money through spreads or commission. So it will depend. But that's just how brokers make their money. So for example, you find a broker offering a spread of maybe 20. So in between that spread, that's how they generate their money. And some brokers, you find that they'll offer you zero spreads. They'll offer you zero spreads, but when you trade, there's a commission that they charge after you make your withdrawals on the profit. Okay, now the spread is measured in pips. So most currency pairs, the base currency and the quote currency, have a pip value which is equal to 0.0001. So for instance, take the following quote of Euro versus the USD, where we have the price quote of 1.1051 against 1.1053. The spread between these 2 points is 0.0002, which equates to 2 pips. I think now you can see how pips are calculated. So what you just do is, for you to calculate your pips, you need to do 1.1053 minus 1.1051, and you get the number of pips. So that 0.0002, you convert it into, you remove the 4 decimal places so that you can remain with one figure, which is 2, and that represents your pip. Now, in the next lesson, we are going to talk about what is Forex. Of course, I'm going to give you a definition of what is Forex as we continue. And also, I'm going to explain more about leverage and pip and spreads as we continue, of course. But I just hope that this lesson has been informational for you, and I'll see you in the next lesson. Goodbye.